saying something. Okay.
Thank you. Welcome to Technology Tuesday. We're talking first-time homebuyers today. One of the things I thought we should talk about is in the event that the starter home is not available, what should first-time homebuyers be thinking about? There's a bunch of technology and startups who are thinking about how to help first-time homebuyers get in the game, get in the market when they can't afford a full starter home. I like to joke that, and maybe it isn't even a joke. I like to say the starter home is dead. Um, the starter home is unavailable. The starter home in many markets is extinct. So today I was thinking I would share with you kind of a chart, a table of what first-time home buyers are doing to try to make up for the fact that they can't get in the game in many high-cost markets. For us, Boston is a high-cost market. So it makes sense to try to think about like what can we learn from the West Coast? San Francisco, Oakland, LA, Denver, increasingly Denver and Seattle are in that category. And so what about that and what's going on out there we can apply to our market? I'm going to share real quick. And by the way, I have the chat open. So if you have any questions throughout the presentation, check the chat and we'll answer those and also uh, talk. Okay, so here we go. No, not that. All right. So as we all know, some of the historical context here is that median incomes have gone up in the last 40 years. They have not gone up in proportion to the 30-year fixed rate mortgage or the median home price. So the more we look at what millennials and Gen Z are facing from a home ownership perspective, the more we're seeing they need alternatives to at least get started in the game in home equity. And so I'm going to scroll down here. I just want to show you kind of a chart. This is what we're going to be talking about today. Sorry for the comments here on the side. Let's do that. This is really what I want to go through today. If you can't afford a starter home in Boston, let's say, or in Metro Boston even, what are your options to get into home ownership and what apps or startups or technology are helping first-time homebuyers do that? And so we're going to go through 5 opportunities that banks or other investors are helping first-time homebuyers find their first home. So let's start with the fact that the starter home might not be available, to me, is actually not a big deal. Everybody wants to talk about making an offer for the starter home with a traditional 30-year fixed mortgage. And I understand why real estate agents, mortgage loan officers, even buyers find this to be a threat. The reality is, for me, if you're approved with, let's say, a conventional AUS, Fannie Freddie financing, if you're approved for a certain credit amount, the actual credit amount is your starter home. So let's say you apply for a pre-approval and the pre-approval shows, let's use $440,000. So the starter home for that buyer is $440,000 less the down payment, right? So 420, $400,000. And they go shopping for a listing price that is the amount of their pre-approval. What I'm suggesting here today, and what I'm working with startups to try to realize, is we don't need to find a listing that matches the first-time home buyer's credit approval. We need to find the credit amount that the first-time homebuyer wants to earn in a home and then match that with available homes in different categories. So a great example would be, I'll use shared equity as a quick example because we've talked about it here on Technology Tuesdays before. Shared equity means you can actually find a house that's $550,000 or $600,000 in the example of the pre-approval for 400 or 440 for that first-time home buyer, and have investors or a platform take the ownership in that other 10, 15, 20%, such that the first-time home buyer actually has their full credit amount that they are approved for, that they're earning over 30 years, and they just found it in a house that was slightly more expensive than the credit amount they were approved for. So I'm kind of arguing here that the starter home is the credit amount you're approved for. And if you can apply that to any different type of house, you have a chance to get in the game and you have a chance to earn home equity. And that's what we're talking about here. So a shared equity platform would actually allow a first-time home buyer to find that starter home, so to speak, with the amount that they're approved for, and do so with the help of an investor to make up the difference on the down payment. There's only 2 or 3 platforms doing this, but shared equity is a great example of how startups or technology funds are helping first-time home buyers find a house that they can afford, that uses their full credit in the market they want. And we really see 3 profiles of a shared equity buyer. And that's one of the reasons I want to start there. It's pretty straightforward. And the technology companies that are supporting this are largely like first-time home buyer evaluation slash down payment assistance algorithms. So this one is, first and foremost, I cannot afford to own a home in my high cost market, but for the 10 or 20% that a shared equity platform would contribute. I like to think of that persona as using the shared equity platform for the rich parents or the rich uncle that doesn't exist. So if you have parents that are going to give you money for a down payment, if you have an uncle, family member, grandparent who's going to give you money for a down payment, then that usually makes up the 10% or more for a down payment. And so last year, we saw 65% of first-time home buyers had money from someone in their family for the down payment. If you don't have that, shared equity is an option to actually contribute to your down payment. And then the investor rides along. They usually and should be a pro rata partner. So if they're in for 10% at the home buy, they're in for 10% at the exit. And the exit usually looks like 10 years or less. Most shared equity platforms will allow the home buyer to have the option to buy out, sell, or refinance within 10 years. And that opportunity, from my perspective, I think of as like compound interest. Compound interest, you have to get in the game and you have to let it compound over time. That's the Warren Buffett, rule. Shared equity can actually let first-time home buyers get in the game and compound their equity, meaning if you're in for a lesser amount of equity first, that's better. As long as it continues to grow, you can then refinance, sell the house, or buy out the shared equity partner for whatever that down payment fund was. Right now, there are 2 companies that I want to bring up. One is called Homium, and one is called Crib Equity. Homium is working with state housing finance agencies. Right now, they're in Utah and Michigan. So I think that would be like a mass housing partner, as an example, in Massachusetts, that would allow you to contribute 10 to 15% of the down payment as a shared equity investment from investors. Crib equity is a marketplace where investors who want to buy residential real estate, and you might be thinking, who are these investors? They are single family rental investors. So you noticed how Wall Street got kind of a bad rap about a year ago, 18 months ago, from buying up houses. And so Wall Street is coming to buy your neighborhood was a very popular, mass media press article a year ago, 18 months ago. But what happened was Wall Street said, I don't need to buy the whole house. If I can buy 10% of 30 times the houses that I'm currently buying the entire house and renting it out, I have residential real estate exposure and I don't have the property management, property maintenance fees. So shared equity is actually a growing piece of the market because it allows investors to get access to first-time home buyers and to residential real estate without buying houses and renting them out. So any questions on shared equity, let me know. But that would be the first way that first-time home buyers are getting in the game with a slightly smaller investment than a typical 30-year fixed mortgage and with a tech or investor partner to buy that house. So first, shared equity.
Hey, Jeremy,
Yes, Debbie.
do you want to mention, I feel like with some of the PR stuff that's happened here in Massachusetts
Mm-hmm.
with shared equity, division of banks don't regulate them. They don't feel like it's a mortgage. A lot of
Yep.
regulators across the country, it's something that they're still, you know, um, not looking at,
Yep.
but they're wondering about. And then our own attorney general, does not like this practice. So it's there's pros and cons to the shared equity. I mean, I think that they're great, but not all understand them.
Yeah, let's talk about the cons. That's a good point. So one of the big things about co-investors or shared equity from the home ownership perspective. So I've just mentioned the purchase product, how to help first-time home buyers get in a home. In Massachusetts, there was actually a company who was buying either some or all of someone's equity out from under them in a servicing context or a loss mitigation context when they couldn't make their monthly payment. And so the regulator had to take a look at this. Obviously, the attorney general stepped in and said, if you're going to buy out someone's equity in a loss mitigation context to get them more cash to help them make their monthly payment or get out from under whatever event caused them to miss their monthly payment in the first place, you have to be very clear on what the value of the house is. So, what is the fair market appraisal on that house? And what are the terms and conditions that would allow them to take the cash, get out from under the event that caused the missed payment, and pay back or buy back the portion of the house that they sold? And a lot of these agreements in a loss mitigation context were causing someone to lose their house altogether. So the investor would make that contribution of a shared equity percentage in some moment when you have a monthly payment where you need to make. And then over time, it turned out they were just buying your house out from under you. And it wasn't clear what valuation they used, what fair market value they used. So in Massachusetts, shared equity can often be looked at as a loss mitigation sort of challenge or even problem. So that's one. And that's the lawsuit that you saw and how the attorney general or some others looked at one investor in that context. Two, we've talked to the division of banks. We've talked to the regulator, and here's what they see as a shared equity play. They see it as an actual equity agreement, as a co-investor agreement. We're going to talk about co-buying and co-ops in a second. But in Massachusetts, they look at co-investment as an equity agreement, not as a lien. Some of the down payment assistance types of shared equity that I've mentioned actually do register a second lien. So they are an equity investor, not a debt um, lender, and they yet still record a second lien in order to have the land records and the securitization work for the portion that they want to sell to investors or that they want to be on the land records as having a right to in case that house gets sold when they're not involved in the transaction. They will be notified as a second lien holder. So there is a lot of confusion nationwide around shared equity because some regulators see that second lien, that notification lien, if you will, and want to call shared equity investors lenders. Right now, of the two I mentioned, Homium, which is operating in Utah and Michigan, does operate as a lender. They do a second lien, they go on the land records, and they have a license that reflects a lender license just in case they need it. Crib Equity is a marketplace that attracts investors who want to buy portions of houses in certain states and then applies their funds like almost in a matchmaking way. And they don't have a lender license and they use their lender partner for the first lien mortgage as the lender license to match with the investor to get the deal done. So, of the two startups or technology companies that I'm talking about, one does have a lender license and operates as a second lien, one doesn't. And that's kind of what Debbie was mentioning about the confusion among state regulators. In Massachusetts, we know that the state regulator operates under kind of that second rubric, which is this is a shared equity investor, so an actual co-investor, and that doesn't qualify for regulation under the Division of Banks as a lender or a second lien HELOC, some other kind of like non-agency second lien lender. And so that's kind of where we are in at least in Massachusetts today. Let's talk about four other options that we're seeing for first-time home buyers and which companies or technology or startups are helping them. So the first one I wanted to talk about was co-buying. The thing I like about co-buying is we're actually seeing on the West Coast, and I'm going to bet increasingly in Boston, we'll see 3 to 4 millennials or Gen Z who already live together or already know each other getting together to buy a house that they would otherwise pay the monthly payment either the same or slightly less in rent. They're just going to try to buy together. And so let's talk about like what's possible and what's good or bad about this model. The good part of co-buying, if you are 3 to 4 unrelated millennials who want to own together, the good news is Fannie and Freddie already do this. You can actually run a loan through, especially Fannie and Freddie and FHA. In some cases, I'll talk about FHA in a second, but you can actually run a loan together, and the AUS can handle it. Fannie and Freddie can accept loan delivery, and the DTI, as I like to say, looks really good on these loans because you have full incomes. So you have 4 incomes, for instance, which is different than co-buying as like a multi-generational family. Still pretty good product and actually still possible with Fannie, Freddie, and FHA. But multi-generational, you don't actually document most of that income. It's either the primary home buyer or the primary home buyer and a partner who apply and are on record for that loan. For co-buying, everybody's on the loan. Fannie and Freddie also allow you to kind of partition those loan applications. So it is possible for those 3 to 4 co-borrowers, co-buyers of a house to have a Fannie Freddie loan and not have each other see their mortgage application from a financial data perspective. One of the biggest things that technology companies and startups are helping with in this cohort is the legal agreement up front. What happens when somebody moves, gets married, or wants to exit the house? And so here, it really isn't the mortgage company, bank, or credit union's job to figure out what happens in those legal agreements when one of the co-buyers wants to leave, because you have these other platforms that have stepped up to help draft, for instance, a legal agreement. It's just a contract. There's nothing more than that usually, but the Fannie Freddie application does not a, does not require a contract. So it's home these home ownership platforms that are really lead gen and financial literacy platforms, who also then offer the the contract. So the one and I'll put this, I'm going to actually pull this link and put it in the chat if you're interested. One of the startups that we're talking about in this case is called Nestment. And what Nestment does is they provide a bunch of calculators and first-time home buyer education, and they work with mortgage companies, credit unions, and banks to curate and nurture leads over a period of time, offering them these options. And then when they find the option they want, whether it's co-buying, co-op that I'll talk about in a second, house hacking, rent vesting, Nestment organizes that application for them, finds them the house, and works with the mortgage lender to then prepare the application properly. So when I think of co-buying, there's a couple different startups out there. I'm just using an example to make the point about technology and how technology can help. But when I think of this is actually a really good option in lieu of a starter home, because now you can start earning equity. You can start making that monthly payment. In a lot of markets, that monthly payment is actually lower than rent for 3 or 4 people. And you can cash in whatever you've earned 5 years, 6 years later as your down payment when you go to buy maybe your primary home without any co-buyers. So co-buying already approved by Fannie and Freddie. From an FHA perspective, it's just a matter of skin in the game. What is the down payment that everybody has to contribute to meet the FHA requirements? So there is a downside here, separate from the, I guess, potential downside that some homeowners don't want to be sharing the house. The potential downside here is you're also on the hook for the whole loan today. Fannie and Freddie have not updated the 100% liability of any co-applicant on a loan. So that will change, I believe, in the future. But for now, you're 25% in for the monthly payment. You're 25% of the home equity, but you're 100% of the risk if you miss a monthly payment. And that is still one of the downsides of co-buying with a Fannie Freddie loan. Let's go through the other three things and what we're seeing in those areas. One, co-op communities. I'm not seeing this in Boston, to be clear. I think co-buying and shared equity are actually really good options in Boston. Co-op communities aren't, so I'm going to move very quickly on this one. But what we're seeing on the West Coast and what we're seeing in other markets is that developers and other nonprofits have stepped in with technology to help um, organize 6 to 8 units on a lot that used to be one house. So I'm going to use Seattle as an example. You might have like a 400,000 square foot uh, house um, that used to be owned by a family. Maybe it's an empty nest. Maybe it's just one owner now. And they're coming in and actually developing that lot to be 8 units in a co-op. And then the owner that previously owned the land gets the buyout from the developer and gets one of the units in that 6 unit community. So we're seeing a lot more duplexes, townhomes, co-op communities going on land that used to be a large single family home. Frolic, would be an example. I'll put that in the chat. But Frolic Communities would be an example of one of these that is operating on the West Coast. Again, not seeing this a lot in Boston, but wanted to mention it. The last two, I think, are really good options for Massachusetts: house hacking and rent vesting. What are we talking about here? So, house hacking is buying one unit of a duplex or 2 to 4 family multi unit property and renting out the other units to offset your housing costs. Why would this make sense for a first-time home buyer? One of the problems is that first-time home buyers um, have to wait longer to buy their first home. One of the upsides of waiting longer to buy your first home is you're a more mature first-time home buyer, and you can potentially be a landlord in addition to a first-time home buyer. So I'll use VA as a quick example. VA allows 100% financing on 2 to 4 family units, allowing that service member to buy a house, live in one of the units, rent out the other two, three, 4 units, and offset their housing costs. So we're seeing more and more kind of later in life first time home buyers buying units, becoming a landlord, and then either offsetting some or all of their monthly housing payment. And so we're calling that house hacking. There are a lot of realtor, real estate, or tech partners creating listing services who can go out and find these properties. I'll use Oakland and Brooklyn as two great examples. We're seeing a lot of this in Oakland and Brooklyn. So Boston might not be far behind, honestly. How do I find one or more units in a property? I'll buy the property, qualify using the monthly payment, meaning using that income from the other units. We're getting better and better as an industry for those like DSCR loans and those investor loans. And if you could kind of pair that technology with house hacking, you can actually eliminate your monthly housing payment as a first-time home buyer. Again, if you find the right unit and if you're willing to do it. The other thing is, which I like about house hacking, you can combine co-buying and house hacking. So two people could buy 4 units, rent out two of them, 50-50 on the equity on the co-application, qualify from both an income and an future income perspective, and then uh, finally make it into the market, in their first home as a starter home. Really like house hacking or co-buying with house hacking in the event that you want to have a partner in that. Finally, rent vesting. And this will be our last category for the day. As always, please put your questions in the chat and I'll answer them at the end. But rent vesting is I'm renting in Boston and I want to buy a house in somewhere else in Western Massachusetts, in New Hampshire, in Rhode Island, and rent it out. And now I'm making some home equity. I'm in the game. I'm making the monthly payment, obviously, and I have to either figure out what's my monthly rent and I'm a landlord, or what's Airbnb look like. But we are seeing uh, in the cohort that I looked at from a market research perspective. Now, this is West Coast, Washington, Oregon, Colorado, and California. 220 first-time homebuyers, 19% chose rent vesting as an option in those high cost markets to buy a house somewhere else and rent it out. And that's an option, in my opinion, for Boston. So if you are looking for ways to increase production, work with a first-time homebuyer platform, or stand up a new program, rent vesting allows somebody to go look for that investment home, and you almost have like the investment home first. And depending on the monthly payment, the location, and how much equity they earn, how quickly, that investment property could become the down payment for their primary home. Or they could just continue to rent it out. That could be their way of finding a starter home, even though they don't live in it. And that's what I'm referring to as rent vesting. So I've kind of made the argument that the starter home is no longer available. And here are some options that we're seeing between startups, technology companies, or banks and credit unions who are rolling out these products to say, how are we helping first-time homebuyers in new and innovative ways? These 5 options are available. And I'll pause there, see if there's any questions. Debbie, I didn't see any additional questions come in the chat.
I
Does
did
anybody?
not.
Yes, thank you. Does anybody else who's listening have any questions? So what we'll do is we're going to record that. We have the recording. We'll distribute the recording. If there's any questions or any partnerships that you'd like to see with some of the startups or technology companies that I've mentioned or that operate in these different buckets for first-time homebuyers, let me know, and we can set that product or program up. We can introduce you, and we'll be back next month with another Technology Tuesday. So thank you, everybody, for joining. Thank you, Debbie, and look forward to coming at you again next month.
Thank you.
Thanks,
See you
everyone.
next month. Bye bye.